thank you very much. Have you had an interesting and worthwhile day? All right. Well, it's been exciting for us, and if it has been good for you, let me ask you to join me in expressing thanks to not only yourselves for making this possible, but to the incredible hardworking staff of the Milken Institute, both the London office, the Santa Monica office, the Washington office, and even the Singapore office have been involved in putting this event together. It has been a great deal of work. They've done a terrific job. So please thank them, and also our partners at Sparks, who provided much of the production services today. Join me in thanking all of them. All right, we have to end this long marathon day with a highlight, and that's what we're going to do as we discuss capital markets with the best person to moderate it, our chair, Mike Milken.
Good afternoon. We're here in London. It's December 5th, 2017, and we've brought 4 experts here to tell us how we're going to expand the European economy through the role of capital markets and finance, and not just Europe. What capital and access to capital and financial markets can do to meet many of the great challenges we face in the future. And as we look at this issue, I'd like to take us back at least to 1965, if we could bring up slide 1, to this formula I wrote down at Berkeley in 1965. And it was essentially that financial technology, different forms of finance, hundreds, thousands of different ways that you could access financial capital, served as a multiplier effect on human capital, the talent and productivity of individuals, the largest asset in the world, social capital, things such as rule of law, if we could go to slide 2, and real assets. And dealing with these issues, if we shut down access to capital, what occurs? And today, at the numerous sessions here in London, but also around the world, discussions continue to ask the question, what are the jobs of the future? Can we meet the needs of people? How do we create better living standards? Both in the United States and in the UK and throughout parts of Europe today, many people in the middle class, lower middle class, have asked the question, how have I benefited from the enormous expansion since the Great Recession that occurred in 2008, 2009? Over the last decade, enormous wealth has been created, but what about me? And in any democracy, if we cannot meet the needs of the people, those are the challenges. So the Milken Institute was essentially founded almost 30 years ago on the principle that we could create financial incentives and access to capital to solve many of the world's problems. Here in the UK, you have now 5 of the top 20 bioscience universities in the world who have brought new technologies and new talents that have extended both the length and quality of life. But that is the challenge in many ways we're facing today. What can capital do, and what can financial markets do to create growth? And as any politician knows, one of the keys to solving problems and to being reelected is increases in economic growth and having people feel they're part of the system and they are benefiting from the growth in the system. So Grace, I'd like to start with you. You have enormous responsibilities at JP Morgan, not only advising clients and private clients and protecting and increasing their wealth, but providing capital to the world, helping companies navigate how they're going to finance their businesses. How do you see the creation of jobs, and what role can J.P. Morgan play in solving these problems?
Absolutely. Innovation really is the lifeblood of economic growth and job creation. When you look around the world, but specifically with regards to Europe and this topic, about 67% of jobs are created by small and medium enterprises. So really ensuring that these businesses can grow, that entrepreneurs can succeed, is absolutely critical in ensuring that the economy can progress. And you actually see a tremendous multiplier impact. Some research that came out of the UK actually shows that if you can boost the growth of high-growth businesses by just 1%, you can get about a 2% GDP impact. So a great multiplier effect. And so really access to finance is absolutely critical, along with access to talent.
So I know, Damian, that in our discussions over a period of time, you've discussed your views as a person that believes in capitalism, free markets, the challenges. One of the areas I'd like you to touch on is we've made so many promises to people from the past. Their pension funds, their endowments, even universities dependent on generating rates of return to meet the needs of their students and the future. Take us a little bit to Australia. What have you learned in Australia? One that could be applied to Europe, in that Australia, Canada, and some other countries are much better funded on their pension funds and future commitments than we are in the United States. And also the significant responsibility you have to the people that you represented, Super Q and QIC and these things over the years, to meet their obligations and to meet future promises that might be made in the future, not just the ones in the past.
Oh, thanks, Mike. So QSuper is a $60 billion pension fund. We're actually defined contribution. So most of the system in Australia has moved to be defined contribution as opposed to defined benefit. So a lot of the pension funds in sort of the US and Canada and around the world are defined benefit. So they've had an annuity stream that they made promises about, which they're now struggling to meet. The defined contribution system in Australia has got some real benefits. So there's compulsory contributions, which is obviously a good thing. One issue with that is that the contributions are only about 9%. Most people who don't really understand that think they're probably contributing enough. They're not. One very good thing that happened in Queensland is that the Queensland government issued some incentives where if people contributed more, the government would match it. So most of our members contribute about 18%, which is about what you need to save enough for retirement. One issue that we do have with defined contribution is that people don't understand how much they actually need. There's been some element of throwing people to the wolves in terms of defined contribution, where they contribute, but they really don't understand what they need to do. And I think part of what we need to do better as an industry is to lead them and guide them and help them with things. Longevity protection is something that we're just coming to discover in Australia after 20 years that our members will need in 20 years' time. So I think we're getting to the point where we're starting to build, to realise we need to build the second half of the system after accumulating for a while.
So as you look at what occurred in Australia, how would you project that to Europe today?
You see more and more in the UK at least and across Europe that it is clear that many sponsors won't be able to meet their defined benefit liabilities, and there's an increasing move from defined benefit towards defined contribution. I think the world is globally heading towards that. I think that there's a real opportunity for people around the world to get together and say, what is the right system? Design it from the back down, say what are the needs, and then to build it through that way. I think the Australian system, we've gone the other way, and you start building at the beginning, and there's an opportunity to do that better. So I think that we're a little bit down the track, and we can pass on some of the mistakes that we've made as a lot of Europe starts heading towards that DC path.
So to meet these obligations, Giuseppe, growing up in Italy, you fully understand volatility in many ways. Just trying to keep track of who's the current prime minister. You know, I think you have to be in 8th grade before you can capture all the prime ministers in a short period of time.
Yes.
And when we look at Europe, obviously it is not one country today. How do you see the issues of potential growth? And obviously you have a lot of responsibilities at Värde. If we just take a look, for example, at slide 3, for example, all the different forms of financial technologies. I look through that, both you and Shankman pretty much invest in every single one of those categories today.
Thanks, Mike.
What do you think could help us accelerate growth in Europe?
Yeah, I think, you know, you hit it on the right point. Europe is not one country, and when you're trying to solve the problem of growth in Europe, you know, you really have to think about, hey, I'm solving the problem of all the countries like Italy, Spain, Greece, that actually didn't really benefit that much, or at least where populations don't feel they benefit that much from the Eurozone. So, you know, with that, I think financial technology extremely important, because I think, you know, somebody here during the lunch break said, you know, the role of capitalism in a way is the one of giving capital to the ideas. And you know, you can argue that in Europe you've had a lot of capital just very much misallocated. You look at the banking system today, it's full of NPLs, particularly around the periphery, and they're not able right now to allocate capital any longer to productive ideas. So where do I think financial investors like us can step in? It's twofold. You know, number one, it can be actually to rid the banks of those NPLs, so they can go back and do all the lendings to the SMEs, which is so important around the Eurozone. And secondly, clearly, you know, where the banks have retrenched and they're not willing to do any more lending, we can step in and possibly provide those companies or people that are looking for capital for their own purposes, purchasing a house or setting up a company. We can be the source of that capital.
Let's go to yourself, Bob. If we look at, pull up slide 5, if we look at the United States, capital markets are substantially different in the United States today than they still are in Europe, UK, maybe a little different, but you can see here by the blue line at the bottom that the amount of capital that is held in loans by the banks has decreased substantially. And so beginning in the 1970s, the United States, in the latter part of the 70s and today, is primarily financed by yourself at Shenkman or Värde. And JP Morgan has a portfolio, but primarily they have identified assets, identified new securities, underwritten them, and provided secondary markets today. Europe has not moved in that direction. And to reinforce a point that Grace made, if we pulled up slide 4, for example, we can see, Bob, and where you live in the United States today, that in the last 30 years of the 20th century, you had 62 million jobs created by small and medium business, what Grace has suggested, the driver. And in fact, during this period of time, you had minus jobs created by large businesses. How do you see Europe? And I know you've invested in securities in Europe. And how does Shankman approach Europe? And what role can Shankman play in helping the growth in Europe?
Well, I think, first of all, to Giuseppe's point, Europe is a multitude of different markets, and there's a lot of differences across Europe. And what works in Belgium doesn't work in Italy necessarily. You don't want to put mayonnaise on your pasta or anything like that. And I think one of the biggest risks for the companies and for capitalism in general in Europe is actually regulation. It really feels to a large extent the regulators in Europe, and you can put up your slide 1551 if you don't mind me stealing your slides, Mike.
My slides are your slides.
Thank you. You know, the U.S. has had a ton of regulation, and unfortunately, I think the European community has more and more regulators, and you know, bakers bake and fishermen fish, and regulators tend to want to regulate. And one of the things they've tried to do is really regulate a lot of the risk out of the banks. The banks have a little bit of a different social contract. They take deposits, they have certain guarantees from the government. But the real concern is here is they try to take all the risk out of the capital markets. And you need risk and you need innovation in the capital markets, and that helps SMEs. It gives us opportunities to invest. And you also want different levels of risk for investors. My 22-year-old nephew and my 88-year-old father want different types of risks in their portfolios. And if you over-regulate and try to take all the risk out of it, you not only get rid of innovation, you get rid of different types of investments that different people need. I mean, part of our job and part of all of our jobs is managing the risk and the returns that different types of investors want to achieve their goals.
Well,
and the regulators can't do that.
You have more flexibility, Bob. Can you invest in any type of security?
Depends on our mandates, and we have a lot of separately managed accounts. We're really a credit shop. We invest pretty much every type of way you can think of below investment grade credit, everything from opportunistically to CLOs to CLO tranches to European debt to US debt. So we do have a lot of flexibility. It all depends on what kind of solutions our clients are looking for. We tend to do a lot of separately managed accounts and a lot of customization for clients.
So Grace, let's go back to yourself. Bob had called up these issues that you had a crisis, and then in response to a crisis, you have regulation. If we look at, for example, the next slide, 51, and just looked at Dodd-Frank, if we continue, you'll see that it has more pages than the Bible, Torah, and the Quran combined from that standpoint. And so you have been the center in your core belief that access to capital to small and medium businesses is the driver of growth potentially for Europe from that standpoint. And so the question is, in many ways, much of the regulation, particularly that came out of the United States, doesn't necessarily give you the freedom anymore to do that.
Absolutely. There have been some very negative unintended consequences of regulation, some of them linking very much back to Giuseppe's point on the MPLs, that actually banks have had to pull back their lending, particularly to small businesses, because they're deemed to be higher risk. And so whilst small businesses across Europe, about 80% of them finance through bank loans, which is not arguably the best source of financing for them, even those bank loans have been pulled back as an unexpected consequence of regulation. So I think the Capital Markets Union and all the aims there are really to open up other types of capital over and above just bank lending, whether that be equity markets, whether it be bringing in retail investors, institutional investors playing their role as well, but certainly broadening out and diversifying access to finance.
If we pull up slide 7 for a moment, we could take a look here at how different European markets are from the United States, where the banks have less than 20% of the holdings in loans versus Europe today. And if we take a look at slide 8, just comparing the United States and Europe job growth, you see there's been a dramatic change in job growth between the two. So as you look at this, Damian, how do we close this gap? What needs to be done? You have the perspective, I think, of living farther away from London than anyone else on this panel here today in Australia. What do you think, as a believer in the free enterprise system, and the challenge we have in trying to close this gap?
Jesus, that's a pretty tough one. So, look, I guess overall, there's many things that have been discussed here in terms of regulation that I think come into play. Like, we do see crisis after crisis, and I think that in part that has been a function of the players in the industry not doing enough to address those issues. So the housing market, for example, and housing bubbles, I think we've got one in Australia, and I think that a big driver of that is that banks lend, and they lend money to people, and they consider getting it back, but they don't really consider if the housing market is overvalued and the risks to that to the overall economy. So I think that there's been a failure there across nations to address that risk. And then as a result of that, you see this boom-bust cycle, except that because banks have become too big to fail and institutions have become too big to fail, they haven't failed, and you've ended up with a situation in in Europe with ridiculous sort of ratios. Is it slide 6 in terms of the size of the banks to the economy there? And those banks are clearly unhealthy. Can we get slide 6 up? So if you look at this is the size of European banks compared to US banks. If you thought that US banks were thoroughbreds and those other banks were horses that came out to race them, would you put your money on those other horses? And I think that that's sort of part of the issue, is that there's a whole lot of issues that have not been addressed. And while there will be things that create opportunities, such as increased credit via issues of paper and stuff in Europe, they can help the issue, but I think there's some big issues that still have to be resolved.
So, Giuseppe, when we look at this slide that Damian has put up, and we were thinking about the financial crisis of 08-09, and today the 3 largest banks in France in terms of assets are as large as the 3 largest banks in the United States, where France has a much smaller GDP. Why hasn't this occurred? Why haven't they shrunk their assets more? Is it the failure of financial markets? Why haven't you or Shankman or JP Morgan or others, allowed them to diversify their assets more, to bring them more in line to the size of their financial markets? I think I've personally been quite surprised a decade later that they haven't sold a lot of these assets in light of how low interest rates are.
I think there is a lot of factors at play in that relationships. I would say the first thing is, in Europe we had a regulator that up until 2014 had to deal with a massive sovereign crisis, right? And so whereas the regulator in the US had the ability in 2009 to overnight recapitalize the banks and force them to sell their non-performing loans and asking them to shrink certain assets, the regulator in Europe had to deal with the potential disintegration of the Eurozone, the exact same thing that the exact purpose that they were created for. So I think, we're starting, although we're in 2017 today, really, we're only 2 to 3 years into an economic expansion within the Eurozone. So there is a cyclical factor at play. I mean, there is certainly, structural forces at play within the Eurozone, and I think the problem is that it's not one market, and when it's not one market, it's very hard to actually create a liquid, non-banked market. The USA is a very large capital market with one language, one set of rule laws, one set of regulations. We don't have that yet in the Eurozone, and so I think, it's a really long road before that will happen. I'm actually quite hopeful. I do believe that the ECB has started to set up the foundations for that to happen. I think M&A across the banks will be very important. All of a sudden, if we were to look at that statistic, but Société Générale were also to own some banks in Greece or in Spain, that will look a little bit less skewed. So I think there is a lot of things that can happen. I'd like to, if that's okay, also touch on a point about the job creation point that you made. A little bit, when we said Europe is not one country, when we think about job creation, I think that the current political class in Europe is failing a certain generation. I feel like my generation, the generation around my age, is being failed. And I think that's what's causing this big drift towards populism, which is really affecting and is really being popular and voted by a very select part of the population. And I think none of that integration, none of that evolution of the Eurozone can happen until that safety, people feel like it's safe to invest in the Eurozone. Until that can happen, we will not see the financial innovation, we will not see this ratio changing.
And
So-
to jump in there, I'd add that obviously you've got Brexit, which, you know, the whole nature of the Capital Markets Union is to bring these very disparate markets together, yet we have Brexit that could potentially drive us further apart. And actually the London market is a very deep, liquid capital market, and the government have done quite a few things, whether it be through sponsoring the AIM market, the alternative investment market, which has been around for about 22 years and raised £100 billion for small, about 3,500 small companies. So very successful model for bringing capital to small businesses. There were also tax incentives like the EIS scheme, the VCT, when it comes to venture capital. So London, whether it be through infrastructure and through government, have actually done a pretty good job relative, arguably, to others in Europe. So that's something that we really have to watch as we, you know, going back to slide 8, when we see that delta between Western Europe and the United States, that Western Europe doesn't fall further behind.
I think one of the questions, Bob, if I go to you, some people don't fully realize for the United States, really, this crisis was 74. It was around the world, but it was really 74. And the challenge to banks, their own survival that period of time, essentially forced it into the public and private markets. And I think what we don't fully realize is in the 1980s in the United States, large banks shrunk as much as 50% adjusted for inflation, but the country grew by public and private markets. When I visit Japan, the leadership, finance ministers, deputy prime ministers, they constantly today question whether Japan's culture, education, the concept of lifetime employment is a challenge to the future. Today, there's 17 trillion deposited in Japan, yielding 0 or minus. And their corporations today, if we pull up, for example, slide 13, the corporations in Japan today have more than 120% of the GDP of the country in liquidity. Mm-hmm. So they're saying, where are the financial institutions? Where are the investors? Have they failed a country? You can't get the people to invest. They are willing to accept a 0 or negative rate of return. We can't increase birth rates. We can't increase the country unless people are willing to invest in the future. And is this a failure of the financial system? And when you look at corporate balances today, slide 12, you'll see it, when you compare where they were prior to the financial crisis, you had Apple that had 15 to 20 billion in cash, not more than $250 billion. Or Microsoft had 23 billion in cash, not 138 billion in cash. And so the individuals are liquid. Even in the United States, liquidity is about double what it was in 07. But Japan would be, you know, the #1 example. But you see this same conservatism in Europe, that if we could unlock savings, if we could get people to take risk, we might be able to create growth. Why hasn't it occurred, Bob?
Well, I mean, some of it is this historical sense in Europe where there's more savings and less investment. There's less of that willing to take a chance. And I think you see it in the banks, and you see it in the banks' balance sheets. I'm certainly not pretending that the U.S. banks are perfect, but one of the problems with, I think somewhat in Australia, but definitely in the European banks, is that they really lack diversity in their portfolios. And they're not, the banks themselves, who are sort of supposed to be the financial leaders, or at least in past generations were the financial leaders, are not diversifying their portfolios and being innovative. They're in housing and they're in sovereign debt here. You know, housing, they say we're comfortable to, you know, lend to real estate because there's asset value. But by the time you look at, if you're looking to the asset value, something has gone wrong in the loan. You want those cash flows, and if they were more aggressive, I think, or more diversified in moving into corporate lending, SME lending, I think the public would feel more comfortable doing it as well. And hopefully the capital markets can develop, and capital will get more diversified. It's not just the investment portfolios that'll get more diversified, the sources of capital. One of the benefits the US and the UK had after the great financial crisis was if the banks were seized up, there were other markets to go to. And I think there was much less of that in Europe. and Europe really needs that. You've started to see it develop in some of the Latin American countries, what's been able to happen in Chile versus what's been able to happen in some of the other countries where they've put strong institutions and really helped their education and quite frankly, I think helped their financial literacy a lot.
Let's talk about another dramatic change that's occurred in financial markets. So if we pull up slide 22, a tremendous increase in private equity. And even if we just look at Europe, Europe has many of the world's leading private equity firms headquartered. If you look at the United States today, slide 23, in terms of employers, 7 of the 10 largest employers in the United States today are private equity firms, and private equity firms today control more firms than are listed in the United States. Do you see any opportunity with this significant investment in private equity to increase the growth rate? And Damian, you've invested in some private equity firms over the years. What are you looking for them to do?
So, thanks, Mike. Actually, if it's okay, I wouldn't mind jumping back to Japan because...
Fine. Take us to Japan.
I see Japan less as a conundrum about the savings and more as a tautology, in that there is a lot of debt that's been issued in Japan. There's a lot of credit there. When you create new credit, you create deposits. So all of that debt that they've created a lot of money, and unless you're in a fractional reserve, which Greenspan gave away, they've created a lot of money that either has got to go into either a fixed set of assets. So you've seen that their bond yields have been bid down incredibly low, so their prices of their bonds are incredibly high. Their share market now, the government or their central bank is at least the 10th highest stockholder in most of the shares there. So is that a market that you want to be invested in? So if you've got given a whole lot of cash, it seems quite rational not to be invested in that. And even if you invest offshore, you've got to sell that cash to somebody else that they've got to decide, do they want to invest it in risky assets or cash? So to me, a high cash balance in a country sounds sensible. It's the flip side of issuing a lot of debt.
But as you know, Damian, the largest pension fund in the world, the Japanese government pension fund, sold $800 billion of their government holdings to their Federal Reserve. And they've been given permission to invest anywhere in the world. So the question is, am I willing to take 0% in Japan when I could have invested in other markets or other things in the world? There's nothing that forces you as an individual only to invest in Japan.
That's correct, but I think when people invest offshore to get the foreign currency, they've got to give that money to someone else, so that's got to get reinvested. So again, I don't want to sort of get into the technical elements, but I think it just is a self-balancing, as I say, tautology.
Okay, Grace, your firm deals with all these private equity firms?
Absolutely.
I think we at the Institute have been trying to tell them, okay, as the largest employers, you have significant responsibilities today, not just to generate rates of return for your investors, but you're going to be held accountable for job growth and other issues today.
Well, I think specifically with regards to private equity and private assets, it is a growing industry because generally the returns that you can achieve are perceived to be higher. And in a world where returns have been falling, as growth has been falling and inflation has been falling, then private assets generally are something that our clients are interested in. I think going back to the previous graph where you saw the cash held by various technology companies, that opens up another very interesting source of finance around fintech. And actually at some point, you've seen Amazon has lent about $1 billion to its own customers over the past 12 months, PayPal following suit.
Pull up slide 12 again, please.
And these businesses are in such a fabulous place to be able to actually appraise the risk of their own customers and achieve real-time information. So I think that will likely to continue. I guess the point just to have a little bit of caution over is at what point do these institutions become banks, and when does regulation again take over and say, well, a bank has to have a specific amount of capital against the loans that you're granting. So another sort of early phase way.
Grace, I think you've brought up a really important point. If we look back to the 1970s, companies with significant cash loan money to their suppliers and loan money to their customers. And so the issue here is, if I'm Facebook and 1 billion people are coming to me every day, could I be your bank? And I don't necessarily be a bank, but I'm sitting with liquidity. I could start loaning money and you could start giving me capital. So Alibaba, as we know, already has over 200 billion in deposits from that standpoint. Damian, both you, and I want to go to you if I could for a moment, Bob, both of you have raised this issue of housing and credit, et cetera. And you might want to differentiate the experience, Bob, between investing in securitized debt obligations versus housing. But if we pull up slide 26, we reflect at the Institute and look at the nature of credit over hundreds of years, there's 6 things that constantly have come up. 1, credit is what counts, not leverage, and many companies increase leverage, generate the same rates of return, but they're not the same credit. 2, most loans to real estate are not investment grade, even though people perceive them in many ways to be riskless. Interest rates are volatile and unpredictable. And so, Damian, your comment about Japan, I haven't decided if I could borrow at 0, is that a liability or an asset from that standpoint? Credit research is more than ratings. BB industrials have a 50% of default rate of AA railroads. Sovereign debt is historically risky. And lastly, debt underpins all markets. So I'd like to go to the panel and really address 2 things here. 1, housing, maybe friends. Second, levels of interest rates are so low that we've forced people into equity. And if we're in an environment where we have not been able to increase jobs with interest rates so low, investors used to pay a higher rate in euros than they did in the US. Today, you can borrow at a lower rate in euros. So it's hard to understand why Europe has not been able to accelerate even more. It's just hard to conceive that interest rates are going lower in Europe. And the sheer fact you can borrow lower in euros than in dollars is an amazing thing. So, Bob, take us to a 1 or 2 minute tutorial on the housing system, securitized debt, housing markets, et cetera.
I don't know if I'm the right person to give you a tutorial on anything, Mike, but
well, I'm speaking of the figurative view here.
The housing market, I mean, I said this before, but I think a lot of the lending in the housing market is predicated on underlying asset values and not cash flows. And when something goes bad in the housing market, there's a lot of product for sale, and suddenly those asset values change. I think one of the important things in corporate credit is really, first and foremost, you're looking to the cash flow that can get generated. In real estate, it's a little bit different in real estate when you're looking at commercial properties, but it's still less cash flow based and often asset based, assuming that there'll always be another buyer there. We tend to believe that the cash flows are what draws the buyer and the ability to generate those cash flows. So when you do look at something like collateralized loan obligations, as you alluded to, you're really looking at the cash flows that those corporations can generate to pay off their contractual obligations, which are the loans, which then can support the collateralized the collateralized security. And all of it is really based more on the generation of cash flows and understanding the credit quality of the underlying assets. And that's one of the differences. I think the other big difference is, obviously, at least in the United States, is how much the housing market has been distorted, again, by government agencies, government regulations, and that concept of everybody should try to own a house, even if it means that they then don't have flexibility to move where the jobs are.
So, Giuseppe, we have lower rates in Europe than the United States. You have even lower rates in Japan. and we still have not seen the job growth creation. So I'm sitting here, I'm in the US, and adjusted for inflation, I'm making less than I did in '99. I'm sitting here in the UK or parts of Europe, and adjusted for inflation, I'm making less money than I did 10 to 20 years ago. Is the economic system, is financial markets failing? Why have we not seen more growth, and what is going to accelerate growth if we feel that this populist movement is going to continue, and the challenge is that the free market system and financial markets are not meeting the needs of the people?
I mean, I think to answer the question where you pose, the financial markets have failed, the average person in the Eurozone. I would argue that the main issue that you face right now in the Eurozone is that this 0% rate is not really benefited by the vast majority of the population. If you look at a country like even Italy, right, only very recently the banks have been more willing to even provide very basic, simple, mortgages to the average individual. It's been since the onset of the financial crisis in 2010 that has been extremely hard for the average person to get on the housing ladder and actually, as we were discussing before, there is a lot of benefits, both financial and not, in actually having high quality housing. And so I think from that perspective, people have a right to believe that the financial system has failed them on average. And I think it's a huge risk. At the end of the day, if you think about fixing the financial system, that means fixing growth. And really, growth is the only thing that I think can fix the Eurozone. If we want to actually be able to make more investment in the Eurozone, we need to believe that we are investing in one single currency. And I think, things are getting better from a political perspective right now. This year, obviously, we had the French elections, which have been good. But I would argue that this is the last chance that Europe has to fix itself. Because you look at this populist party, and they've received so much votes that now you need to tilt 5 to 10% of the population into them, and that's it. You'll end up having a major country in the Eurozone governed by a very populist party, and then all bets are off. They're certainly going to be anti-capitalist, they're certainly going to be anti-Eurozone, and they certainly can create significant damage to their own population and to the growth and ultimately to the dream of the Eurozone.
If I could jump in and say, I think it's not just capital markets, it's arguably also the education system, because one of the reasons why inflation is so low and job creation has been low is because of the impact of technology, and many jobs obviously have been displaced, over even just the medium-term history. So making sure that...
It is estimated, Grace, for example, in a recent study by McKinsey, if we just took the UK, that as much as 30% of all the jobs in the UK over the next 15 years are at risk from technology.
Absolutely, and the way that those jobs are being displaced is different. With the emergence of blockchain coming, that's a different tier of jobs that are potentially being removed versus what we've seen over the past 10 years. So I think education has to evolve. There has to be greater collaboration with businesses, with universities, and then obviously the role of capital markets to make sure that those ideas get funded.
But those take long. Those are longer time solutions, and I think sometimes the public's not willing to wait for those solutions, especially after we've had a financial crisis, both in the U.S. and then in Europe, and after you've had some rough times, especially in some of the countries like Italy and Spain and Greece, because those educational things that people do get displaced by technology, and that technology historically does create new jobs, but it takes a period of time for those new jobs to be created, and it takes a period of time for people to be educated about those new jobs. What you'd hope is that in that process, the capital would flow a little bit freer, maybe from the people that are building up these cash pools to help create other small businesses and create other jobs for people who are maybe displaced but still entrepreneurial.
Well, I think it's a question of time here. And I thought I might put up slide 59 for you, Damian, here. Let's take a look at 59. And who is that individual?
So Ronald Reagan,
So I'll read you the quote. Government's view of the economy could be summed up in two short phrases. If it moves, tax it. If it keeps moving, regulate it. And if it stops moving, subsidize it. Let's take a look at another individual I know you grew up admiring. Slide 58. There can be no liberty unless there's economic liberty. So I don't believe the financial community can sit back and say it's the educational system that hasn't prepared people, and it's technology that hasn't prepared people. I can't tell you how hard it was to finance the mobile phone industry. You would think it would have been the easiest thing to do, but we created these relationships because no one else would finance it at the time. So I don't believe there's an excuse. And if these two individuals, how old were you when you started to admire it?
Well, I swapped some notes on the way up and pass on that in our household that Reagan and Thatcher's were heroes, and that's sort of the background. So definitely free markets are in my blood, but I did raise concerns that I feel that some things have gone, not as well as they should have, and perhaps that's because markets have been too free. And we talked about some of the excesses in Europe. So I think that low rates in Europe are an example of stimulus. The thing about stimulus is that it should be cyclical. You should have times when you stimulate, and then there's times when you contract, and on average you get a normal economy. So that if you only stimulate, you're trying to get people to borrow. Once everyone who's borrowed has borrowed, it becomes pretty ineffective, and that's the situation that you've ended up with there. One thing I think is incredibly disappointing is the narrow goals that we have. So I think Giuseppe said if there's no growth in the Eurozone, then it's in trouble. And I think it's in trouble because when you look at the population growth, the overcapacity, the debt levels, growth is probably going to struggle a bit. Germany's starting to borrow against their houses, so that's kind of nice in the short term. But I think that one country that's starting to lead a bit of the thinking here is China. They're saying, look, it's not just GDP, it's the quality of GDP. And a little bit, Mike, like your initial slide, saying like, it's not just growth, it's this prosperity, it's these range of different outcomes there. And you look at the incredibly narrow, how many smart people are there in the central banks? And they seem to focus only on inflation as the measure of excess and missing things like if markets are overvalued. So I feel that the authorities really aren't sort of showing the lead there and leading with a broad enough range of objectives.
But I guess I would go back to the 1980s, early 1970s in America. The banks were in serious financial difficulties, primarily because of emerging markets, a $1 trillion loss that eventually went through the system. Bank of America was the second largest company in the world, and at the end of the 1970s, they weren't one of the 10 largest companies in the world at the end of the 80s. But public and private markets provided capital for job growth from that period of time. The challenge of finance, let's pull up slide 51 as an example. So it's the late 1980s, early 57. It's the late 1980s, early 1990s in America, and acid rain was going to kill everyone. Movies, books, documentaries, and the financial system created, if we could just click that one more, we'll see what happened, but the financial system created these sulfur index bonds. And so you were required to reduce SO2 emissions, and if you couldn't, you had to buy a bond. And if you could reduce them by more, you got a credit, and you could sell it. So a financial market grew up, and 15 years later, no one's talking about it anymore. It doesn't really exist. And so a creation of a financial market solved that problem. Now, we could discuss here among the group, there's a lot of different, if it's education, maybe we can find a way, not bringing us back to Dickens or debt or prison, but maybe we could pay for your education and agree to some share of your future income from that standpoint. But it just seems like the clock is ticking today. And if I don't see growth in Europe, if I'm a European company, I'm still allowed to invest any place in the world. And that comes back to the benefit of the shareholders and the employees of that company. So I think that's one of the real challenges. That's our challenge this year at the Milken Institute. But that is the challenge here at our London Summit. The Brexit has made it more difficult, far more difficult as you search it out and find the solution. But Europe needs to grow. And the middle class and the lower middle class particularly has to feel they're part of the future. And I guess that is our challenge. And because the four of you signed up for the last panel today, we're looking for ideas, whatever they might be, and what role your firm could play in them. Grace, what innovative thoughts do you have that JP Morgan might be able to do?
So certainly when it comes to ESG and social investing, that's an area that we're focusing on at the moment, and that's resonating extremely well with clients. A lot of our clients have built family businesses. It's a long-term investment mentality, and this theme absolutely resonates with them as just the right thing to do, the sensible thing to do. So that's one very tangible way that we're progressing things.
And that has obviously been a central theme. The Capital Markets Group at the Milken Institute, representing almost 25 trillion now in assets, is a core, and JP Morgan has been a leader in this area, and congratulations. Damian, you're looking all the way from Australia, and Australia is too small to take all your capital, so you've got to invest around the world. What do you see? What money managers are coming to you? They have a fund, they have a pitch that you see could accelerate growth or job growth?
Well, look, one thing that we are quite excited about is the prospects in Latin America. So we see that as, I see that as a potential engine of growth for the global economy. So what you have there is a significant region that's only had about 20% access to the banking system. I think it was Larry Summers said about China that urbanisation is their golden ticket. I think that what happens with urbanisation is that you get access to credit. You start building bigger houses, and that creates employment. And I can see that cycle, and that's a healthy cycle when you're starting from sort of 20% to build credit and to do that. So I can imagine that in Latin America, a lot of the fintech starts to provide that credit to the greater population, and you start seeing that virtuous circle of wealth, creating more wealth, and et cetera there. So I think that that's a region that I would expect to evolve a lot. And it's got a lot of good bones, if you like. They generally know the right thing to do. They've often got good institutions, or the backbone of a good institution, even if they haven't always followed the right thing, sort of like following.
So you're telling us you're willing to deploy the capital for opportunities in Latin America?
So we've invested in local currency Brazilian bonds and Colombian bonds over the last 12 months.
Okay. Well, if you could put money in the Spanish institutions who then loan to Latin America, maybe we can get some growth here. How about yourself, Bob?
You know, I'm going to build on the ESG SRI theme because, I mean, it means a lot of different things to a lot of different people. I mean, some people are very focused on the E, some on the S, some on the G, some on how long management teams take a shower for. It means all different kinds of things. But a lot of it tends to be focused more on the negative. And, oh, I don't want to invest in a company that, you know, does extractive services. I don't want to focus on this. And socially responsible investing can be very positive. You can say, I want to invest in a company that takes care of their employees' retirement plans. I want to invest in a company where the company provides education for the children of the families that work there. So you can take it from both the positive and the negative on ESG and SRI. And you know, there's a lot of different types of economic activism, and this is one of them. And I think it needs to be focused a lot more on some of the positive than just the negative. And I think that's a way that the credit markets in general can really start to be a real changer in making the world a better place.
Giuseppe, if the audience here in our capital markets group tripled the assets of Värde, where would you deploy the money today?
Look, Europe for us is interesting. You know, I think we said a lot of bad things, not bad, but you know, we had a lot of negative things about Europe today, and in a way that is a source of opportunity very often. You know, I think when I look at the positive side of things, there is a huge amount of potential for catching up growth. You know, there is a lot of slack within the economy, there is an educated workforce that has been out of job for a very long time, and that probably wants to go back into jobs probably more cheaply than other markets out there, maybe the United States or other markets where, you know, reaching closer to full employment. And as you highlighted, there is a huge overbanked system, and I think the role that my firm or other firms can play is one whereby you can disintermediate them, right? You can help the banks to actually get rid of some of these assets that they really shouldn't be owning. You can help where the banks have retrenched. You can actually help providing capital to companies and people that need it for growth. And that's, I think, you know, it's probably an exciting time right now to be in Europe for over the next 4 to 5 years. Obviously, we've taken the view that the Eurozone will survive, and therefore, you know, you will not face that, you know, very dark side of the moon kind of scenario.
So we have constantly pushed all four of you here. And as we think about the world today, the greatest growth in the world's population will be in Africa. UN has projected as many as 3 billion additional people, whether it's 1, 2, or 3 in this balance in the century. But if they don't have opportunities in sub-Saharan Africa, they'll be looking for Europe for those opportunities. So one of the things, obviously, we could do is look to how we provide capital to grow there. One of the challenges that we have is people look at finance in this gender. If I go back 30 years or so, and you looked at these lists of wealth, there was very few people ever in finance that had wealth, relative. Today, we have large numbers of people, so I think it's only fair. When you talk about G, Bob, or you talked about G, Grace, you can't blame it on someone else today. When I went to Wall Street in the late 60s, the utility curve of the CEO might overlap with the shareholders. It might be rare. Today, if private equity controls more companies than are listed, and you've lost half the listed companies in the United States, then in that sense, you have an alignment between the owner and the management from that standpoint that exists. So I don't think there's any way we can excuse the challenge to finance. Damian, why did you, including here today, why did you go to work in the financial world?
Look, why I went and what I believe now are probably two different things. So I started as a chemical engineer, and you drift through life, and a door opens and you walk through it. And now, as I manage funds for pension, for people going to for their pension, we go out and we address the members, and we have, you know, little old ladies come up to us, and we're looking after their entire life savings, and they are incredibly grateful for us. We do a good job. They're even more grateful than we deserve, actually. So I think that I feel a wonderful obligation to them to try and do as good a job as we can, and it's a privilege.
Thank you. Grace, another person who was a chemical
I know, I'm in good company here. So
Okay.
yeah, absolutely.
Why did you choose to go into finance?
So post a master's in chemical engineering, I joined Deloitte & Touche to study for my chartered accountancy, which I did for 3 years. And it was after that that I then came into the city, originally joining Cazenove, which was a stockbroking house. And for me, it was just the dynamism, the fact that you could meet with these CEOs, that you could discuss their business plans, that you could take a view, but that you're continually learning. Markets will always change, they'll always evolve, and to me that's extremely exciting.
Bob, why did you go into finance? I know you spent a number of years at Credit Suisse, you've written books, you've written papers.
Well, I stumbled into it. I was a poli-sci major and figured I had to figure out what economics was, so I took a class and was fortunate enough to have a great professor and fell in love with Hayek and von Mises and all those guys. And then I through soccer or football, I had a bunch of friends from Trinidad, and I went down to Trinidad with some of them, and their parents are entrepreneurs, and I suddenly understood the difference between economics and finance, and that finance was sort of that real world getting things done. And it's been a great stumble for me. I've enjoyed it through Credit Suisse and certainly with Shenkman. And it is kind of fun every day that what you do affects what's in the newspaper or on the internet these days, I should say. And what's in the news affects you every day. It's a great feeling. And it is a lot of responsibility. I don't think it was an accident that the first client Mark Shenkman had me go sit across from was a police pension fund. I mean, you're sitting across from people whose literally put their lives on the line for you, and you're protecting their retirement. And it certainly makes you feel it. So it's a little bit more than just why I went into it, but it's also why I've stayed in it.
Giuseppe?
Both my parents were accountants, and in true Italian style, I was supposed to become an accountant as well, because you're supposed to do what you can do. And so I went to study, I guess, accountancy and finance. And as I was in university, I stumbled upon a presentation by actually J.P. Morgan, who were looking for interns. And I thought it was fascinating. They were saying that, they were helping all these companies, raising capital, doing M&A and all. And so I thought, you know what, I'll give it a try. My parents will allow me to do an internship. It's okay, then I can go back to accounting. And so I did the internship, and I came to London, and it was just too interesting, right? I mean, doing deals, looking at these big companies, working in an extremely dynamic environment. It was too hard to pass, and that's where I stayed since then.
So a lot of excitement, a lot of opportunity, a chance to change the world for people. And I think in closing, the challenge is, can we meet the needs of the people? As we look at Venezuela or Zimbabwe, we fully recognize the benefits of a free market system, of financial access to capital. As we move to smartphones as becoming your bank in many ways and your deposits, we still have this challenge. If you look back at 1993, the most admired companies in the world for more than a decade were the large pharmaceutical companies. And in less than 6 months, this industry went from the most admired to a piranha charging too much for their products. And one after another CEO would say, I thought we were doing God's work, finding the solution for life-threatening diseases that we have no solution for, as the price of many of the world's greatest pharmaceutical companies fell by 50%. In 2009, 2010, one of the CEOs of one of the larger financial institutions in the world also commented, I thought we were doing God's work, providing capital to create jobs. I think this panel, we tried to underline the challenge, not just for the 4 panelists, but for the financial system itself. In democracies, can we bring prosperity, meaningful lives to the citizens so they feel they're part of it? If not in democracy, as one of the great Greek philosophers said, even if you don't have interest in politics and government, they'll have interest in you. So thank you very much, and thank you for joining us today. Hope you enjoyed it.
Thanks, Giuseppe. Pleasure.
Excuse me. Hope you enjoyed it.
Thank you very much, Mike. Really enjoyed it.
I tried to get that emotion out of you.
And please join us for our reception, some cocktails right outside. Thank you.